Okay. Good morning, everyone. Hope you are all keeping well. So today onwards for the next 5 sessions, we are having one of the most important standards, both from an academic level as well as from a practical perspective. That is Ind AS 115 that deals with revenue from contracts with customers. Okay, now why is this particular standard so important? Number one. And secondly, how is it important from the perspective of practical application? Number two. And secondly, how is my session going to be conducted? So these are the topics that we will be first understanding, and thereafter we will be proceeding to look at the proper standard in detail. Okay, so just a second. Okay, just give me a minute, please. Okay, yeah. So this should be fine. Okay. So now let us continue. All right. If you recollect, we had a standard under the previous accounting regime that dealt with revenue recognition. That was AS9. We also had another standard that dealt with revenue recognition for contracts. I mean, for what you can say, long-term projects. Okay, so we used to have a separate standard for that dealt with revenue from construction contracts. These were the two standards that broadly dealt with revenue recognition under the erstwhile regime, under the erstwhile IGAP regime. Ind AS, when it first came into existence, as we all know, it is drawn from the IFRS. So we had two particular standards there, that is IAS 18 and IAS 11. Okay, which were of course taken over in India as Ind AS 18 and Ind AS 11. So now these two standards were introduced initially. Now, when I say these two standards were introduced initially, I mean to say that Ind AS 18 came in as the normal revenue recognition standard, and Ind AS 11 was specifically pertaining to construction contracts. Thereafter, there was a project between the International Accounting Standards Board, that is the UK-based standards, as well as the United States-based standards, and that gave to the genesis of IFRS 15, which is the revenue recognition standard in force today. And pursuant to IFRS 15 coming into force, we brought that same standard once again into our purview as Ind AS 115. So with the coming of Ind AS 115, these standards are no longer prevalent. Ind AS 115 has superseded the requirements of Ind AS 18 as well as Ind AS 11. In other words, what you have to understand is we do not have a separate standard now that deals with construction contracts also. The revenue standard that we are having here is a common standard that deals with construction contracts as well as it deals with the regular contracts that you are a witness to. So this is the background behind the formulation of this particular standard. Coming to now, what are the changes that have been proposed by Ind AS 115? Why was it necessary to have a separate revenue standard when we had an AS 9 and AS 7 separately? What was the need to integrate the construction contract standard with the regular revenue recognition standard? So these would be some of the questions that I will first be addressing with the help of an example. Okay. So now let us assume that you go to the showroom, you go to a Maruti showroom to buy a vehicle. Let us assume you bought a vehicle. The cost of that vehicle is rupees 15 lakhs. Okay. The cost of that vehicle is rupees 15 lakhs. Now, when you buy a vehicle, you also get a couple of other things associated with that. Sir, for example, you are having a 3-year warranty that accompanies the vehicle. And along with the 3-year warranty, you are also having 5 free services. So all these things put together make up your invoice value of the vehicle. So when I have to say the invoice value of the vehicle, how does it look like? It looks something like this. Rupees 15 lakhs. I'm forgetting all the taxes, etc., whatever is there. This is the bare invoice price, the taxable value of the vehicle. Okay. Now, good morning, everyone. Good morning, Vanshika. Good morning, Manisha. Good morning, Viraj, Shruti. Good morning, Tanisha. Good morning. Okay. So now, I want you to tell me, so far what you have studied. Those of you who know 115 very well, but I'll not come to that right now. But those of you who are under the erstwhile regime, when I buy a vehicle from a Maruti showroom, what would be the entry that Maruti would pass, the showroom would pass when it sold the vehicle to you? What would be the entry that the showroom would pass when you pay them 15 lakhs and you go and take the delivery of the vehicle? What would be the entry? Come on, tell me, everyone. What would be the entry that the showroom would pass? Yes? The showroom would get the check or the draft or the RTGS in its bank. So the showroom would pass the entry, bank account debit, 15 lakhs to sales. Am I right? This is what you have studied? Yes or no? Bolo. Please tell me, is this what you have studied? Yes? Excellent. So, Ashwini, Yukta, Mohammed, Dheeraj, Shailesh, Krishna, Swati, and Ashu. Everybody has given the same entry. So, by and large, you people are on the right path. So, this was the entry that would be passed, bank account debit to sales, 15 lakh rupees. Now, what was the basis for passing this entry? What was the basis for passing this entry? Sir, the basis for passing this entry would be that the showroom has transferred the risk and reward in the vehicle to the customer. The showroom has transferred the ownership, with the ownership, the risk and the reward to the customer. And that is why at that particular point of time, the revenue was recognized as a sale on account of transfer of ownership, risks and rewards contained in the product to the customer. And that is why the that is why the sale entry was passed. Okay. Sir, but along with the vehicle, we are also having two obligations. Am I right? Yes, we are having two obligations. One is a 3-year warranty and another is a free service, numbering to 5 free services. So what did we do? Sir, as far as we remember, under AS regime, we used to create a provision for warranty depending on the best estimate of the costs that I would incur to service the warranty. So I would be having a provision for warranty that would be passed immediately. So the entry for the warranty would be warranty costs debit to provision for warranty. To provision for warranty. And this would be at the best estimates. This would be at the best estimates of the warranty cost depending on the past trends, patterns that you are having. Similarly, you would have a provision for servicing costs as well. You would have a provision for servicing costs as well, to provision for free servicing. Do you recollect doing this? This entry was passed under AS9. And these two entries would come under the purview of AS29. This would come under the purview of AS29. I had to do the provisioning because I am getting obligated to deliver two things. One is a warranty service for a period of close to 3 years. And secondly, you would have the 5 free services. So I had to recognize a provision in my books in accordance with AS29. Are you clear with what we used to do under the AS regime? Yes, everyone, are you clear? I need you to understand this because Ind AS 115 is a tactical shift in the manner in which revenue is recorded in the financials. That is why first I have to draw your attention to what we used to do under the erstwhile regime. Is everyone clear? Yes. Is everyone clear? Anybody has any doubt so far? Okay. Now let us move to what Ind AS 115 thinks about. Ind AS 115, look at the words which are used. Revenue from contracts with customers. So basically, it talks about all forms of contracts that you enter into with customers. We will see further what do you mean by contracts, who are actually my customers, and how do you proceed. So all the theoretical portion will come subsequently. Okay. Now let us understand that Ind AS 115 follows an obligation satisfaction based accounting. Sir, come again. Ind AS 115 follows a performance obligation satisfaction based accounting. It permits you to recognize revenue when performance obligations are satisfied. It permits the recognition of revenue when performance obligations are satisfied. Sir, AS9 bhi to wahi kar rahe the. We were doing the same thing in AS9 also. When the risk and rewards were transferred, then only we used to recognize the revenue. The transfer of risk and rewards was my performance obligation there also. So what is the difference? There is a difference. In this very contract, we are having how many performance obligations? Sir, we are having 3 performance obligations. One is the transfer of car. Second is provision of the warranty services of 3 years. And third one is giving 5 free services to the owner. So these are 3 performance obligations. So what happened? So now what 115 tells us is, You cannot recognize entire 15 lakhs revenue when the car is transferred to the customer. Q, because I have fulfilled only one performance obligation out of the 3 performance obligation that I was supposed to have fulfilled. The warranty performance obligation will be fulfilled after a tenure of 3 years, and the free services will be fulfilled once the customer has completed 5 free services. Until then, can I recognize revenue from these respective performance obligations? Answer is no, you cannot. And this is the radical shift that Ind AS 115 brings about. Under AS 9, everybody, without even thinking, subconsciously, some of you unconsciously gave an entry, bank account debit to sales, 15 lakhs. Some of you may not have been able to think about the provision entries, but all of you would definitely concur with and would recollect after I wrote the entries that yes, we have to make a provision. Ind AS 115 says no. Why do you have to make a provision when the performance obligations that were required to be satisfied under the contract themselves are not satisfied? So therefore, instead of recognizing a full revenue of 15 lakhs and a provision for warranty and servicing thereafter, we will recognize the revenue in a phase-wise manner. We will recognize the revenue in a phase-wise manner. But sir, how will we come to know how much should go for the car, how much should go for the servicing, how much should go for the warranty? Kaise malum padega? How will we come to know? Invoice price comes with a simple description, 15 lakh rupees. So how will the Maruti showroom recognize the revenue as and when a performance obligation is fulfilled? So for that, we have a small guidance that is there. As of now, I will just discuss it for the purpose of this discussion we are having. But we have to discuss this in great details as we move further. So now, what the standard tells is, you look at the performance obligations, okay? And when you look at the performance obligations, you identify what would be the standalone selling price of fulfilling these performance obligations. Okay. So now when I talk about standalone selling price, suppose you go to the showroom and say, I only need the car. I need only and only the car. I don't want your warranty. I do not want your free services. I only want the car. Okay. So what the company will say, if you want only the car, then the cost of only car without warranty services is 14 lakh rupees. 15 lakh is a combo offer. 15 lakh is a combo offer, warranty plus servicing plus the vehicle. But if you want only the vehicle, you will be having the price stated as 14 lakh rupees, no frills attached, Okay. Now, when I talk about a warranty, I will go to the showroom and say, look, I have a car, but I need a 3-year warranty from you. Okay. So what the showroom will say is, if you want a 3-year warranty, the cost of that warranty is going to be rupees 1 lakh. The cost of that warranty is going to be rupees 1 lakh. Okay. And lastly, I go to the showroom again and ask them, I need your quotation for free services on the vehicle. So when I say free, it's technically not free. So I have to tell them that please give us your, please give us the quote for each time I bring a new vehicle to servicing. So then he will do a calculation. He will look at the oil filter, changes, running, etc. what could probably happen. And then he will give a quote and say that, sir, for 5 free services, we are going to charge rupees 50,000. Okay. I'm taking higher numbers. Don't worry about the numbers. This is just for us to understand. So total of the standalone selling price is 15 lakh 50,000. Total of the standalone selling price is 15 lakh 50,000. Means, suppose from showroom A you buy only the car, you will have to pay 14 lakhs. You take that car and go to showroom B and ask for a warranty, you will pay 1 lakh there. And you go to showroom C with the same car and tell them, I have car, I have warranty, please tell me the servicing cost. He will say it is 50,000. So the standalone selling prices is 15 lakh 50,000 rupees. But sir, मेरा total invoice value तो 15 लाख ही है ना? My total invoice value is only 15 lakhs. Why this gap? This is what is commonly, you and I know it by the name of trade discount. The entity is buying anything and everything related to the car right from the showroom. So it becomes kind of obligatory upon the showroom to give a good deal. They cannot say that we will do everything at MRP. So now this is the story as of now. So what Ind AS 115 tells us is, you will allocate the selling price on the basis of standalone selling prices. Okay. So my ratio is 14:1:50. So let us start. 15 lakhs divided by 15.5 into 14 lakhs. That gives you 1354,839. Is everyone with me? Is everyone with me? Yes. All I did is I allocated the combined selling price of 15 lakhs in the ratio of the standalone selling prices of each performance obligation. Just check the total. Does it come to 15 lakhs? Yes, it comes to 15 lakhs. It comes to 15 lakhs. Okay. So now understand, when you go to the showroom and you pay them 15 lakh rupees, you are getting three things: a car with a warranty and 5 free services. Okay. So what entry the showroom will pass under Ind AS 115? Sir, the entry will be bank account debit. This won't change. Bank account debit or customer debit, whatever it is. So that is 15 lakhs. To answer me right now, when the car is given to the customer, at what time is that obligation fulfilled? You have an obligation to deliver three things. One is a car, second is warranty, third is free servicing. So now you tell me, when is the obligation to deliver the car fulfilled? Is it fulfilled now when I give the key to the customer? Is it fulfilled after 3 years when the warranty ends? Is it fulfilled after the 5 free services are ended? When is the performance obligation relating to the car fulfilled? What do you guys think? When is it fulfilled? Now, after 3 years warranty, or after 5 years servicing? When is the obligation fulfilled? Come on, quick. Exactly, Dheeraj. This is fulfilled right now. This is fulfilled right now. The moment you give a key to the customer and the duplicate key and you take a photograph, The showroom will put it on its Twitter bio or on its Facebook status, whatever it is. This is our 10,000th customer. This is our 11,000th customer. And you also put it immediately on your social media. That means the moment you do this, the obligation of transferring the car is fulfilled right now. So since I fulfill that particular obligation, can I say that I have the right to recognize the revenue right now relating to that obligation? Absolutely. You gave the key, uske baad whatever he wants to do with the car, let him do. He may choose to sell the car. He may choose to utilize it for himself. He may choose to run it as a taxi. He may choose to sell it back to the showroom. He can do anything and everything with the car that the customer wants. Okay. So here I will immediately recognize the revenue. Revenue from sale of car. How much will I recognize? Sir, I will recognize 13,54,839 rupees. Okay, I will recognize 13,54,839. Sir, what about the remaining? Have I fulfilled the warranty services right now, or will it be fulfilled after 5 years, after 3 years? What do you guys think? When will the warranty services be fulfilled? Is it getting fulfilled right now, or is it getting fulfilled after 3 years? Is it getting fulfilled now, or is it getting fulfilled after 3 years? After 3 years. So can I recognize that revenue right now? Answer is no, you cannot. What about the servicing? Sir, servicing bhi wahi hai. Servicing also same thing. I will be fulfilling only after 5 free servicings are done. So therefore, I cannot book the revenue on that. I will instead write it as a contract liability. I will show it as a contract liability and recognize it in the balance sheet. 1,45,161. Okay. So this goes in the P&L as revenue. This goes in the balance sheet as a contract liability. This goes in the balance sheet as a liability. Let us suppose that this sale had happened on 1st April 2023. This sale had happened on 1st April 2023. So this is the entry that will be passed. This is the entry that will be passed on the first day. Now, on 31st March 2024, you will assess. Okay. Sir, 1 year is over. Yes. Out of how many? Sir, 3. So can I recognize 1/3 revenue? Because in the case of warranty, it is a service that is provided for a continuous span of 3 years. It is a service that is being provided for a continuous span of 3 years. Sir, but suppose gaadi kuch hua hi nahi, kharab hi nahi hua, vehicle did not get spoiled. See, that is a reassurance for you, right? Suppose something goes wrong. The showroom, the company is there behind you to protect you in the event of any manufacturing defect in the vehicle, etc., etc. So therefore, on 31st March, have I fulfilled part of the warranty obligation? Have I fulfilled part of the obligation? Sir, what do you mean by part? Warranty is for 3 years. Out of that, 1 year is already passed. So can I say that I have fulfilled 1/3 of the warranty obligation? Yes. So can I recognize revenue from warranty to the extent of 1 year? Answer is yes. The balance will remain in contract liability. So the entry that will be passed is contract liability debit to revenue from warranty. So therefore, how much will this come to? Sir, this will be 96,774 into 1 by 3. 96,774 into 1 by 3. 32,258. Correct? 32,258 is the revenue that you will be recognizing at the end of year 1. Acha, at the end of year 1, you will also come to know two things. So, another extra thing. What is the servicing? What is the number of times the customer has come for servicing? In fact, you need not wait for this till the end of the year. The moment the customer brings his car for servicing, the moment the customer brings his car to the showroom for servicing, the showroom does the free servicing and gives the car back to the owner. So therefore, can I say that for every servicing that the entity, that the customer comes, I can book a proportionate revenue? For example, during 23-24, suppose he came once on 1st November 2023. Let us assume that he came on 1st November 2023. Okay. On 1st November when he came, I am under an obligation to do 5. But out of 5, he underwent the first free service. Okay? So I will then recognize proportionate revenue. Contract liability to revenue from servicing. This will be 48,387 into 1/5. 48,387 into 1/5. 9,677. 9,677. The moment vehicle exits the showroom, that point of time, you are going to recognize the revenue of 9,677. This same step will continue every time I either complete 1 year or every time the customer brings his vehicle to the showroom for servicing. So that will be 32,258 at the end of each year, number 1. And it will be 9,677 at the end of each servicing that is being provided free. Have you understood this concept? Yes. Have you understood the concept? And have you understood the difference in the way revenue is recorded? Yes. Have you come on? Revert. Shruti, I'll just revert to your question. Okay. Understood. Okay. Now, all of you said you have understood. Abhi zara soch ke batao. Think, take your time and answer. Do I have to recognize a provision for warranty and a provision for servicing based on the fresh journal entries that we have now passed? Think and answer. Do I have to recognize a provision for warranty, a provision for servicing in respect of the warranty and servicing assurances that I have given, or can I go on an actual accrual basis? Can I go and record on an actual accrual basis without having to make a provision for the same? What do you think? What do you think? Do I still make a provision, or can I say we will record on actual basis? What do you think? Under AS 9, if you remember, we had made a provision. I recognized 15 lakh revenue, and because I was to provide warranty and servicing, I would recognize a provision for that. Will I recognize the provision here? I want many students to answer this. Come on. I need Ashu, Manisha, Vanshika, Viraj, Shruti, Tanisha, Yedu, Ashwini, Yukta, Krishna Swati, Dheeraj, Rajiv. Come on. Tell me. I want everyone to give an answer. Okay. There are some students who are saying that we need not make a provision, while some of them are saying we have to make a provision. Okay. I need more answers. I got answer from about 5 to 6, only 4 to 5. I need more answers. Okay. All right. Fine. Okay. Let me make you further aware of this. Okay. Let me give you further clarity on this. Under AS 9, your P&L would look something like this. I'm just doing a simple T form P&L, though we are not permitted to do that. Okay. Right now, the class is not on preparing the financials. The class is solely on making you understand. Okay. Now, under AS 9, I had recognized sale of 15 lakhs. I had recognized sale of 15 lakhs. Okay. Now, against the sale, I would have cost of goods sold, correct? वो जो मारुति गया ना, I would have the cost of that, yes or no? And against this, I would be providing warranty and I would also be providing servicing. So provision for warranty and servicing. And that would give you your net profit. Forget all the other costs and all. I'm not interested in that right now. Okay. This would give you your profit. Now, under Ind AS 115, P&L looks something like this. Sales would be how much? Sir, when I sell it, it will be 1354,839. Cost of goods sold. You people are very good in matching. Yes. So now, what is this sale from? Is it the sale from, is it the sale of a car? Is it the sale of a warranty? Or is it the sale of the service? Or is it all put together? Sir, ये तो सिर्फ कार का sale है. This is only the sale of the car. If this is only the sale of the car, debit में क्या आएगा? The debit is going to be only the cost of the car. I cannot have the debit of the warranty provision. I cannot have the debit of the servicing provision because I have booked the revenue only relating to satisfaction of the performance obligation of delivering the car to the customer. जो मैंने किया, I have done that obligation. I have fulfilled that obligation. I booked that revenue. Therefore, I have to book that cost. Now, in the next period, when I book the warranty income. When I book the warranty income, when I book the warranty income, when I book the servicing income, I will have sales, warranty, and this is servicing. What is my warranty sale? 32,258. This is at the end of each year. And at the end of each service, 9,677. Now you tell me, against the warranty and the servicing, will I book a provision, or will I say, sir, year is over, I actually have incurred the cost, so book the actual costs. Book the actual costs towards the servicing and the warranty, which gives you your net profit. That means on an accrual basis. Now in the second P&L, can I recognize my servicing cost? Yes. Can I recognize the warranty related costs? Yes. Do I have to make a provision? Answer is no, because it's already recognized. It's already recognized. So follow accrual basis, do the accounting of the costs on actual basis. Is it understood, everyone? Is it understood, everyone? Those of you who said provision is required, are you clear with the understanding now that when I book the initial vehicle sale, there is no need to make a provision. There is no need to make a provision. Subsequently, when the revenue from the services to be provided starts hitting the P&L, you just ensure that the costs are recorded on an accrued basis. That's it. Apart from that, you have no other reason to debit your P&L with. Is this clear, each and every one? Is it clear? Understood. Okay, Dheeraj has confirmed. Muhammad was right. So now, what do you say? Rajiv, Vanshika, Ashu, Ashwini, Krishna Swati, did you understand? Manisha, did you understand? Vanshika, did you follow? Tanisha, did you follow? Yukta, did you follow? Shruti, did you follow? Everybody has understood this part clearly. Yes? Okay. Right. Good. So I am happy that you people have understood. Now, there may be some, since many of you are doing articleship, you would be exposed to a lot of things. So there may be some students who will obviously ask a question, sir, GST invoice of the showroom will have 15 lakhs plus GST thereon. But you are saying I will recognize only 13,54,000 and warranty and servicing sales separately. Won't there be a mismatch between my book sales versus the GST sales? Hoga na? When did I refuse? I did not refuse. Yes, I did not refuse. I'll give that, Ravish. Okay. There will be a mismatch. But see, I am not preparing the financials for GST law. I am preparing financials for financial reporting. GST law is recording based on invoices which are raised. So there will be a gap. There will be a gap on account of this. And because there will be a gap on account of this, we will have to have an advanced system where reconciliations can be done on a real-time basis to ensure that your reported numbers and the GST numbers are properly reconciled on account of this treatment. Okay, but this is not going to be what you can say. This is not something which you sit and match with the GST returns. No. This is something which you have to do in accordance with the standard. Is it okay? Yes, everyone, is it clear? Okay. All right. Now, let us move on to the next one. Couple of doubts. Somebody asked, how did we get 13.5455 lakhs, 13 lakh 54,839? Very simple. You just cross multiply. You have the standalone selling prices. You have the consolidated selling price here. So 15 lakhs divided by 15 lakh 50 into this. So that gives you your breakup of 1354,96 and 48,387. Okay. So that is how you got that. And the mismatch, you have to do a reconciliation for your records. Tomorrow when the department comes and asks the reason for the mismatch, you will have to explain it to them. There is no other option. Okay. Next. We already have a mismatch even under AS 9. If you recollect, we already have a mismatch there. Okay. So, reasons for the mismatch could be multifold. Okay. All right. Now the next one is, anybody else had a doubt? Okay. Sir, how the contract liability is 1,45,161 when the total trade discount is 50,000? So what Anshika is asking is, sir, your trade discount is 50,000. Your trade discount is 50,000. But how am I recognizing a contract liability of 1,45,000 when the trade discount is only 50,000? I will be recognizing this 1,45,000 over the remaining tenure. I will be booking it as a revenue. So at the end of the 3-year period, you would have recognized entire warranty income. At the end of 5 services, you would have recognized entire service income. So ultimately, this contract liability will ultimately become your revenue. And therefore, the ultimate revenue which you are recognizing still remains at 15 lakhs only. So therefore, the trade discount portion remains at 50,000. The trade discount portion remains at 50,000. Have you understood? Yes. So please don't get confused with that 1,45,000. That 1,45,000 will ultimately come to the P&L over a specified tenure in accordance with the contract. Is this clear? I don't think I have left anybody's doubt unanswered. Has everybody understood? Yes. Has everybody understood? Yes. Ravish, you came to know how we got the breakup of that 1354,839? Shruti, did you understand? Yes. Okay, fine. All right. So that concludes a bare introduction to the standard. Now, let us come to the to some couple of points. Okay. See, this one presentation, I'll share it towards the end of the session because there are a couple of things I still need to improvise on. So that is what I'm doing right now. So towards the end of the session, you will get the presentation. Okay. Now, we come to the standard proper. What is the objective of Ind AS? To establish principles that an entity shall apply. So that is the requirement setting that it does. To report useful financial information to users of financial statements. Purpose of reporting. What should you report? The nature, amount, timing, uncertainty of revenue and cash flows. So this is what you have to report, which arises from a contract with a customer. So this is what you will be recognizing. This is what you will be having as the objective of Ind AS 115. Is it okay? Yes? Is it fine? So if you open your study material, somewhere you will be having the same details also. Okay. Establishes principles to report useful information about nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with a customer. Is it okay? Yes. So the preliminary thing which is there. Okay. Next. So what is the core principle of Ind AS 115? What is the core principle behind this standard? An entity shall recognize revenue. For what? To depict the transfer of promised goods or services. So basically, the revenue recognition shall depict the transfer. Matlab, the way in which I transfer the goods or services, in that way only revenue should be recognized. Earlier, we had recognized 15 lakhs revenue and made a provision. But was it depicting the transfer of goods and services? Answer is no. Services were still not yet, services were still not yet performed. And therefore, recognizing 15 as revenue was not adequately correct. Is it okay? So therefore, the objective is to ensure that revenue shall be recognized to depict the transfer of goods or services in an amount that reflects the consideration to which the entity expects to be entitled. In exchange for those goods or services. Is it clear, everyone? Yes. Is it clear? Have you understood the core principle? Yes. Okay. So what the standard further tells is an entity shall apply this standard, including the use of any practical expedients, consistently to contracts with similar characteristics and in similar circumstances. Okay, so you consistently follow the standard with similar characteristics and in similar circumstances. You can use any practical expedient as well. Just give me a minute, please. Okay. Yes. So the standard gives something known as a practical expediency. Okay. So basically, the standard specifies the accounting for an individual contract with a customer. Okay. However, as a practical expedient, an entity may apply this standard to a portfolio of contracts with similar characteristics if the entity reasonably expects that the effects of applying the standard to the portfolio would not differ materially from applying this standard to the individual contracts within that portfolio. Lot of English. Let us understand a simple example. With that example, you will be absolutely clear about the practical expedient. Okay. Let us suppose you are an organization that has 1,500 employees. Okay. Now, these 1,500 employees working under you, you have to give them phone connections. You have to give them phone connections. Now, when you have to give them phone connections, you will tell these employees, go to Airtel's office, tell them that you are our employee. We will give you a letter in support of that. They will give you the SIM card, and then you take the SIM card and you start using it. This is not a corporate plan. These are 1,500 individual plans that will be given to the customers. Who are the employee of the company. Now, 1,500 employees will go to Airtel store and when they go to the Airtel store, at that point of time, they will be recognizing the each customer as an individual contract. They will be recognizing each customer as an individual contract. So in other words, what I want to say is Airtel will have 1,500 individual customer contracts, and therefore Airtel will have to apply Ind AS 115 to each individual customer contract. That means similar contracts, Airtel will have to revisit and apply the standard 1,500 times to recognize the revenue. The practical expediency that is given here is that Airtel can choose to aggregate all the 1,500 contracts together. Why? It can choose to do so because it is probably of the opinion, and rightly so, that if I aggregate this, there will not be materially any difference between the individual, between the individual contract assessment that is envisaged under 115 versus the practical expediency given under the standard. There is not much of a gap, and therefore you can carry out the assessment application of Ind AS 115 to the entire 1,500 contracts reviewed and applied Ind AS 115 together instead of individually. So this is the practical expedient. Has everybody understood this? Yes. Has everybody understood practical expedient? Yes. Any doubts? Any doubts with the practical expedient? Anybody has any doubts? Okay, everybody understood. So let us then proceed further. So what comes under Ind AS 115, or rather what does not come under Ind AS 115? So one is obviously contracts which are included under other standards. For example, lease contracts under 116, insurance contracts under Ind AS 104, financial instruments Ind AS 109, other contractual rights or obligations within the scope of Ind AS 110, Ind AS 111, Ind AS 27, Ind AS 28. So any contract which falls under this purview, any contract which falls under this purview are obviously governed by those standards. So when they are governed by those standards, they are not going to be covered under Ind AS 115. They will be scoped out of Ind AS 115. Okay. Next one. Non-monetary exchanges between entities in the same line of business to facilitate sales to customers. Okay. Or potential customers. Okay. So now, suppose you are an oil refinery. You are an oil refinery situated in Jamnagar. Okay. Suppose you are Reliance situated in Jamnagar and you have a customer who is situated in Guwahati, Assam. So you have a customer situated in Assam. Now, this customer of Reliance requires oil immediately. But the Jamnagar refinery is not in a position to deliver immediately. It is not in the position to deliver immediately. Okay. So if it is not in a position to deliver immediately, 1 second, please. Okay. If it is not in a position to deliver immediately, then what will the oil refinery do? It will contact another oil refinery. Let us suppose that it is IOCL. Okay, one is Reliance Industries, another is IOCL. Now, Reliance will tell IOCL, look, there is an urgent requirement of oil for my customer in Assam. Kindly do the needful. So depending on Reliance Industries request, it is going to supply the oil to the Guwahati based customer in Assam. Now, these are non-monetary exchanges between two entities. IOCL will also probably have a customer in Surat, Gujarat, and the Surat based customer wants crude oil urgently. So therefore, Reliance will deliver the same to the Surat based customer. These are known as non-monetary exchanges. These are known as non-monetary exchanges. See, Reliance requests IOCL to deliver oil to its customer. IOCL requests Reliance to deliver oil to its own customer. So between both of them, is there any money that is exchanged? Answer is no. They are exchanging goods to each other's customers because of close proximity to the customer. So इसको हम लोग बोलते हैं non-monetary exchanges. So now the question is, between Reliance Industries and IOCL, is there a possibility of Ind AS 115 being applicable? Is there a possibility of Ind AS 115 being applicable? The standard says it is an exclusion. So it is excluded from the purview of Ind AS 115. I want you to tell me why is this particular treatment excluded from Ind AS 115? this particular non-monetary exchange, why is it excluded from Ind AS 115? I want you to tell me. Don't tell me because it is non-monetary. Revenue can be recognized even when consideration is paid or received in kind. It need not always be cash. So don't tell me because it is non-monetary. I want you to look at the name of the standard, and I want you to tell me why is the contract between Reliance and IOCL outside the purview of Ind AS 115. I want you to tell me that. Okay. Look at the name of the standard. Look at the understanding of non-monetary exchanges, which I have explained to you right now, and then give me the answer. Why is Reliance IOCL transaction outside the purview of Ind AS 115? Think and answer. सोच के बताओ. Yes, exactly. Reliance and IOCL do not have a customer-vendor relationship. Reliance has a customer relationship with a customer in Guwahati, whereas IOCL has a customer relationship with its customer in Surat. So therefore, those are contracts with customers. Whereas between Reliance and IOCL, do you have a vendor-customer relationship? No. IOCL did help Reliance, but at the same time, Reliance helped IOCL in a corresponding contract. So there is a non-monetary exchange. That's it. You haven't done anything special for each other. You haven't treated each other as customer in the first place. Neither Reliance pays IOCL nor IOCL pays Reliance. Is it okay? Have you understood? So therefore, the oil company is not our customer. Do not say that between the same entities in an industry, they cannot be customers. No. You may be having certain companies, like for example, you are having the Apple smartphone, and some crucial parts of the Apple smartphone are supplied by Samsung, if you must be aware of it. The camera, earlier it used to come from Sony. So the competitors of each other are also supplying the goods to the to each other. And there it is a customer-vendor relationship. But in this case, non-monetary exchange, there is no customer relationship, because it is a non-monetary exchange. You are transferring goods to respective customers of each other. There you have Ind AS 115 applicable. Here there is no need to apply Ind AS 115. Okay. And finally, when you enter a contract, this standard is applicable only if the counterparty is a customer. Only if the counterparty is a customer. A counterparty would not be a customer if it has contracted to participate in an activity or process in which the parties to the contract share in the risks and benefits that result from the activity or process, rather than to obtain the output of the entity's ordinary activities. Okay. So now let us understand with an example once again, what does the last exclusion indicate? You fell ill, let us presume, and you had to take a medicine. Okay, you had to take an antibiotic. So what do you go to the medicine store? The medicine store, you go to the doctor. The doctor will prescribe the medicines. You go to the medicine store. You give the medicine, and you give the prescription, get the medicine, take the medicine, and come back. What are you? Sir, I am a patient. Yes, but you are a customer for the pharmaceutical company. What are you interested in? Sir, I am interested in getting well. So are you interested in anything more beyond that? Answer is no. Answer is no. So what are you going to do is you will just ensure that you got the medicines as per the prescription and you take it as per the prescription. That's it. That's what a customer does. But suppose two entities enter into a contract with each other. Okay, you have two what you can say, you have two pharma companies. For example, you could have Cipla on one side and Pfizer on the other side. Okay, the pandemic came, they wanted to manufacture the COVID-19 vaccines. So therefore, Cipla said, we will give our facility to you. Glenmark said, we will give the technical know-how. So therefore, both of them join hands. Glenmark giving the technical know-how, Cipla giving its manufacturing facility. Both of them started to develop the vaccine. They developed a vaccine and they sold that. Okay, they sold that. What kind of an arrangement is this? Sir, this is a collaboration arrangement. This is a collaboration arrangement. Typically, what could happen in such arrangements is Glenmark gives the technical know-how to Pfizer. Pfizer will manufacture and sell, and Pfizer will ultimately give a share of that to the to the Cipla or whatever manufacturing company it is. Now the question is this a customer contract? Is this a customer contract wherein you enter the words that Glenmark will partake the share from Pfizer or Cipla, whatever it is, depending on what is the response of the public to the vaccine. Okay, depending on what is the success rate. This is what is going to be the contract. Now, Glenmark gives its technical know-how. Pfizer gives the manufacturing facility. The goods are manufactured in Pfizer's facility. It is then sold to customers. Once the sale proceeds are realized, Glenmark is going to get a collection. I want you to tell me, in this case, is Glenmark fitting in the role of a customer? Is Glenmark fitting the role of a supplier because it is giving us the what you can say, is it fulfilling the role of a supplier because it is giving the technical know-how? Is Pfizer a supplier because it is giving its factory? Is it a customer because it is receiving the inputs from Glenmark? What is the relationship between both of them? The relationship between Glenmark and Pfizer is not that of a customer relationship. Why? Because both of them have collaborated to such an extent. That they are now interested in how each entity is performing. When you go to buy medicine and the medicine is from Cipla, do you think that you will be interested in how Cipla is performing? आप बोलोगे sir हमें ठीक होना, I want to get well, I cannot survive like this, and therefore what are you going to do? You will merely buy the medicine and come and not break your head on anything. But in the earlier example of Glenmark and Pfizer that we saw, both of them are going to be worried, or both of them are going to have an interest in each other's both of them are going to have an interest in each other's businesses, because that is a collaborative arrangement, and collaborative arrangements are excluded from the purview of Ind AS 115 because it is something more than a customer relationship. customer relationship. Have you guys understood? Yes. Have you guys understood? Have you guys understood? Yes. Tanisha has confirmed. What about Dheeraj, Vanshika, Aditya, Manisha, Mohammed, Shankar, Vanshika, Ravish? All clear? Is the exclusion part clear? Is the exclusion part clear? Okay. So that is the objective. This is the scope of Ind AS 115, where contracts are partially within the purview of Ind AS 115, where contracts are partially within the purview. If the principles to separate or initially measure one or more of the contracts are specified in such other Ind AS, the entity should apply separation or measurement in those Ind AS, exclude such measured amount from the transaction price, and allocate the remaining amount to each performance obligation or any parts of the contract identified by para 7b. Not specified in any other Ind AS, apply Ind AS 115 to separate and initially measure the part or parts of the contract. Okay. What does it mean? Suppose you are entering into a contract, jisme you are having what you can say multiple applicability of standards. A part of the contract you could have a part of the contract you could have Ind AS 115 applicability. A part of that could be other standards applicability. Now, what does it mean? We discuss with an example. Suppose you have mortgage assistance by the bank, and the bank also gives you insurance services. Now, the mortgage assistance by the bank, the value of that service goes under Ind AS 109 because it is a financial instrument, and therefore it is covered separately under 109. But there could be other assistances also, like for example, they give you insurance services. Now this insurance service is going to be covered under Ind AS 115, and therefore the revenue thereon will be recorded in accordance with Ind AS 115, whereas the mortgage assistance will be recognized in accordance with Ind AS 109. Have you understood? Yes, contracts partially within the purview of Ind AS. So go through this chart for homework. It's the same thing, just put it in a chart form. Okay. Is it clear so far? Yes. Is it clear so far, everyone? All well? Good to go? One or two confirmations? Okay, fine. So now we come to the 5-step model which is prescribed in the standard. And this 5-step model is the basis for accounting. The most crucial model you will study in your Ind AS curriculum. Okay. So the 5-step model commences with first one, identify the contract with the customer. Second one, identify the performance obligations in the contract. Third one, determine the transaction price. Fourth one, allocate the transaction price to the performance obligations in the contract. And fifth one is recognize revenue when or as the entity satisfies its performance obligations. Okay, so this is the classic 5-step model that you will have to understand and remember. So first one is identify the contract with the customer. Second one is identify the performance obligations in the contract. Third one is you determine what is the transaction price and allocate that to the to each of the performance obligations. And fourth one is last one is recognize revenue as and when the performance obligations are satisfied. So now with this we have broadly understood what Ind AS 115 is going to be all about, and basis that we will now study each and every step 1, 2, 3, 4, 5. We will be studying each and every step in detail for your understanding. Okay, fine. So now coming to step 1, identifying the contract. Contract is an agreement between two or more parties that creates enforceable rights and obligations. Enforceable is obviously a matter of law. Okay. Should the contract be written only? Not necessary. It can be written, oral, or implied by an entity's customary business practices. What do you mean by customary business practices? Has anybody heard the word customary business practices? Has anybody heard the word customary business practices? If yes, what do you understand by that? Yes. Have you heard customary business practices? Okay. No. Anybody else? Tanisha? No. What about the others? No, it's not modus operandi as a routine practice. Okay. Let us come back to the original example that we did. Of the vehicle. Now, when I look at the original example of the vehicle, suppose 5 free services were guaranteed as per the contract. But additionally, the showroom used to do an oil and filter change at the end of the fifth service. The entity provides a complimentary oil and filter inspection and change if necessary, and inspection if necessary. Okay. So now it is providing this to all the customers. Though it is not mentioned in the contract. Suppose you go to that particular showroom and you buy a car, you enter into those free services, etc. Okay. Now, as a customer, do you expect that the oil filter inspection and subsequent replacement, etc. would be you expect that to be serviced to you, or do you say ठीक है नहीं होगा तो चलेगा मेरे लिए? What is your reaction as a customer? Will you say that it's okay, it's fine, it's not there in the contract, or will you say You did an oil filter change for the previous customer. Do that for me also. What is going to be your reaction? What is going to be your reaction? Quickly answer. Yes. What is going to be that? What is going to be your expectation? Will you expect him to do the oil change for you because you did it for somebody? Or will you say, ठीक है, if it's not in the contract, it's not in the contract? You will obviously say, you did it for the previous customer, do it for me also. Why you are not doing it for me? So in other words, the fact that as a business practice, the entity was doing an oil filter change has given rise to a constructive obligation, not a legal obligation. So when we say identifying the contract with the customer, the contract here does not necessarily mean a legal contract. It could also mean something which is implicit. It could also mean something which is a constructive obligation. Suppose the customer does not give you the free oil filter, that he gives it to everybody. Can you take him to the court? Can you take him to the court and ask the court that, sir, this particular showroom is not doing an oil filter change for me? Do you think the court will, your argument will hold true in the court? Answer is no, it won't. Because legally speaking, the contract does not have these terms. Whereas, technically speaking, the showroom has created an expectation in the minds of the customers. And the showroom has no realistic alternative but to perform that obligation. इसको हम लोग बोलते हैं constructive obligations. Constructive obligations. Okay, we call this as a constructive obligation. And in the contract, when we talk about customary business practices, it will more often than not give rise to a constructive obligation. Will give rise to a constructive obligation. All right. Now, that is why they are saying contract could be written. This is as per the Contract Act. It could be oral, yes. Implied is not there in the Contract Act. You can open the Contract Act and see there is no definition of implied contract. But under Ind AS 115, we are going to have to look at the customary business practices also. The practices and processes for establishing contracts vary across legal jurisdictions, etc. In addition, they may vary within an entity. An entity shall consider those practices and processes in determining whether and when an agreement creates enforceable rights and obligations. If an entity has an established practice of starting performance based on oral agreements with customers, it may determine that such oral agreements meet the definition of a contract. Okay. As a result, an entity may need to account for a contract as soon as performance begins, rather than delay revenue recognition until the arrangement is documented in a signed contract. So this is what you are going to review, what you are going to look at. The guidance makes it clear that rights and obligations must be enforceable. Rights and obligations must be enforceable. And when we talk about enforceability, it is a matter of law. It is a matter of law. So an entity needs to consider the local relevant legal requirements and needs to consider and to make that determination of the contract terms. While the contract must be legally enforceable, the key words are oral or implied promises may give rise to performance obligations in the contract. may give rise to performance obligations in the contract. Is it okay? Yes. Yes. So now, when we talk about identifying the contract, when we talk about identifying a contract, it should have 5 criteria. It should have 5 criteria. And these are absolute crucial criteria. They must have it. If they do not have these 5 criteria, if it does not have these 5 criteria, then what you are going to have to do is, if it does not have these 5 criteria, you will again reassess the contract, and you will keep on reassessing until you identify that there is a contract, until you identify that there is a contract. Because the wording of the standard is revenue from contract with customers. जब contract ही नहीं रहेगा after your review, what are you going to review? What are you going to review? Is it okay? Yes, all clear. Any doubts? So what are the 5 criteria? Approval from parties. It could be in writing, orally, or as per other customary business practices. As per other customary business practices. The contract and have approved, the parties have approved the contract and are committed. So you need approval and you need committed to perform the contractual obligations. Both are required. Next one is, the entity can identify each party's rights regarding the goods or services to be transferred. Okay. Identify identify each party's rights regarding the goods or services to be transferred. Okay, to be transferred. The entity can identify payment terms for the goods or services to be transferred. Important. The contract has a commercial substance. That is, the risk, timing, or amount of the entity's future cash flows is expected to change as a result of the contract. It's probable that the entity will collect substantially all of the consideration for the goods or services that will be transferred to the customer. Okay. So these are the 5 things that need to be met. 5 points to qualify as a contract. To qualify as a contract, you are going to what you can say, you are going to evaluate the contract in the light of these 5 points, and it's given on top only. Step 1 serves as a gateway through which an entity must must pass before proceeding to the later steps. If at the inception of an arrangement the criteria are not met, it will not apply steps 2 to step 5. When a contract meets the 5 criteria and passes step 1, you will not reassess the step 1 criteria unless there is a indication of a change in facts and circumstances. So at the inception of each contract, you will evaluate whether it is a contract. And once it is a contract, you will then proceed to evaluate steps 2, 3, 4 and 5. But agar wo contract hai hi nahi, if it is not a contract, then what you are going to do, if it is not a contract, then you cannot even proceed with 2, 3, 4 and 5. You can ask for a reassessment of the said contract, review the terms once again, arrive at a decision, and that cycle will go on until you have met all these 5 conditions. You have met all these 5 conditions. Have you understood? Have you understood this part? Yes. Have you understood this? Bolo. Anybody has any doubt so far? See, today and tomorrow will largely be theoretical. Okay, today and tomorrow will largely be theoretical. Okay, you guys want a break now, or do we take a break later on? Okay, Ravish confirmed, Ashu confirmed, Vanchika confirmed, Tanisha confirmed. Yes, you want a break now or we continue? Come on. Boys, nobody is responding. Boys. Okay, fine. We take a 5-minute break. It's 8:35. We resume at 8:40, 8:42. Okay, we take a 5-minute break right now, and I'll try to leave you guys by 9:40, 9:45. Okay, so that's why a shorter break is preferred. So we take a short break right now and then continue after 5 minutes. Okay, all right. 5 minutes break, please. Fine. Okay, so welcome back, guys. So now we continue with the session. Okay. So now when we talk about the 5 criteria that the entity has to, that a contract has to pass in order for it to become a contract that is going to be covered under Ind AS 115. Let us discuss those criteria in detail. The parties must have approved the contract and are committed to perform. So this is the first criteria that needs to be met. So this approval could be written, oral, or implied. Under the Contract Act 1872 that we follow, implied contracts are not recognized. It's written, oral, anything. But here implied contracts also are there, as long as the parties intend to be bound by the terms and conditions of the contract. The changing of the oil filter, which was a complementary thing, is something that you expect, and the supplier is bound to do that to you. Okay, so that is how it works. The form of the contract is not determinative in assessing whether the parties have approved the contract. So whether it is written, oral, etc., वो सब कुछ मायने नहीं रखता. That's what it's trying to say. As long as the parties have approved, it's met. The condition is met. In some cases, the parties to an oral or implied contract may have the intent to fulfill their respective obligations. The entity must also be able to conclude that both the parties are committed to performing their obligations. Very standard terms which are there. Okay. All right. So this is what is your first criteria. An entity may include a requirement in a contract for the customer to purchase a minimum quantity of goods each month. But the entity may have a history of not enforcing the requirement. So many times you are having contracts where you have to purchase a minimum amount of goods in a particular month. If you have not procured that, if you have not procured the minimum number, then what will happen is you may not be given a particular discount, or you may be given a higher rate, or you may be subjected to certain penalties. But in this case, if you are given that particular, if you are given that particular contract term, but the supplier does not enforce it, then it means that it is a customary practice. And you cannot say that I have not purchased, you have not purchased, so you pay this penalty. जब आपने enforce ही नहीं किया इतने साल तक, when you have not enforced this condition, you cannot wake up and enforce it right now. Okay, it is against business practices, customary business practices. Okay. Next, criteria 2, they can identify each other's rights as well as the rights of all other parties to the contract. You should not know only your rights. You should know the rights of the counterparties as well. All the parties to the contract. An entity cannot assess the transfer if it cannot identify each party's rights regarding those goods or services. The entity can identify the payment terms for the goods or services. Very crucial. Okay. See, ultimately you are entering into a revenue contract where you have to be sure about when the revenue starts getting accrued to you. An entity must be able to identify the payment terms for the promised goods or services. Identifying the payment terms does not require that the transaction price be fixed or stated in the contract. As long as there is an enforceable right to payment and the contract contains sufficient information to enable the entity to estimate the transaction price, it is sufficient. See, for example, you are having a factory, and in the factory you have a diesel storage tank of 2000 liters. So if you have a diesel storage tank of 2000 liters, why did you put this? Suppose there is a power failure, whatever happens, the grid is down, then you can use this diesel to run the generator and thereby run the factory. So this is a 2000 liter tank, diesel tank, and you have contracted with a diesel vendor to ensure that they supply the diesel to you. Now the contract is such that the diesel vendor tells, look, the consideration will be whatever is the rate prevailing at the beginning of a particular day. That will be the rate I'm going to charge you. So has he specified the transaction price in the contract? Answer is no. But has he specified the mechanism in which the transaction price can be determined? Answer is yes. And since he has specified the mechanism in which the transaction price can be determined, the contract is a valid one. Criteria 3 is said to have been met because the payment terms can be identified. But sir, amount to diya nahi hai. Amount dega kaise? How we can give? Petrol and diesel prices are generally dynamic in nature. So if you are entering into say 1 year or 2 year or 3 year diesel purchase contract, you cannot pinpoint a particular rate and continue with that for 1, 2 or 3 years. Keep it a dynamic pricing, but tell the mechanism in which that pricing is going to flow. Okay. The entity can determine then what will be the transaction price. The entity can determine. If the payment terms cannot be determined, on the contrary, if the payment terms cannot be identified, then the contract itself cannot remain in existence. The contract itself cannot remain in existence. Why? Because it is a revenue contract. Because it is a revenue contract. Criteria 4, the contract has a commercial substance. Very, very important. See, earlier this was not there. Okay, even the Contract Act does not have any of this particular criteria. But this is one of the most significant criteria that we are having. That is, commercial substance must exist. Commercial substance must exist. Sir, what do you mean by commercial substance? What do you mean by commercial substance? Commercial substance means there must be a meaning to your transaction. There must be a meaning. There must be some economic sense to the transaction that you are entering into. Let us assume that you are having two companies, A Limited, B Limited. Both of them are dealing in the sale of Skoda cars. Okay. They are dealing in the sale of Skoda cars. Now, A Limited has an inventory of 15 cars of the Skoda Rapid Skoda Slavia model. Okay. I'm just making this up. And B Limited also has an inventory of 15 cars of Slavia model. Now, A and B have poorly performed. A and B have poorly performed. Unka sales zyada nahi hai. So the sales manager of A Limited goes to the sales manager of B Limited and tells them, listen, both of us have failed miserably in meeting our sales targets. Ek kaam karte hain. We have to show the management we have sold. So let us do one thing. I will transfer these 15 cars to you and you transfer 15 of your cars back to me. That way we are booking the revenue. Let us do this for 3 to 4 times. And then 15 cars, each car is worth about 20 lakh rupees. So 15 into 23 crore rupees. Let us round turn it about 5 times. We would have made a revenue of 15 crore rupees from this transaction. And A and B Limited, they both agree on this particular treatment and they proceed with doing the treatment. Now, you tell me, is this contract having any commercial substance? Is this contract having any commercial substance? Is this contract having any commercial substance? What do you guys think? Is this contract having any commercial substance? Obviously no. You are exchanging the same model of cars to each other as a barter transaction just to inflate your revenue. So there is no commercial substance. When I say commercial substance, I mean to imply that by virtue of the transaction, the cash flows of each entity start to get impacted. Okay. Suppose it is Slavia and you are exchanging it with, suppose 15 Slavia cars, you are exchanging it with 5 Skoda Superb. 5 Skoda Superb model of B Limited. And this you are going to do it once. Now, is this transaction having a commercial substance? Answer is yes. Because the cash inflows of A Limited is going to get substantially affected. The cash inflows of A Limited is going to get affected when it transfers the 15 cars that it has and it receives 5 Skoda Superb in return. So earlier, by selling one vehicle of one Slavia, probably A Limited was earning about 14 lakhs or 14.5 lakhs. But when it got now one Skoda Rapid for every 3 Slavia that it returned to B Limited, that one Skoda is fetching it about close to 45 lakhs. So there is a change in the cash flows. There will be a change in the maintenance, the warranty, the servicing of the Skoda Superb vehicle as compared to the Slavia model. So therefore, this transaction does have commercial substance, and that is why whether a transaction has a commercial substance needs to be assessed on a case-to-case basis. Okay. What is crucial though is that the contract must have a commercial substance. Have you understood this? Yes. Have you understood this? Anybody has any doubts? Okay, Tanisha has confirmed, so I'll proceed further. Mohammed, hope you understood this. Okay, all right. Now, coming to criteria 5, it is probable that the entity will collect substantially all of the consideration. So you will also have to check the collectibility. Arey bhai, when you sell the goods, you have to also think of paisa kaise aayega, how will the money come? To pass step 1, an entity must determine that it is probable that it will collect substantially all of the consideration. Very, very important. In determining whether collection is probable, entity considers customer's ability and intention to pay, considering all relevant facts and circumstances, including past experiences with that customer or customer class. Okay, credit risk is something that you will have to just review, but it should not affect the measurement or presentation of revenue. The standard requires an entity to evaluate at contract inception whether it is probable that it will collect the consideration to which it will be entitled to in exchange for the goods or services that will be transferred to a customer. Okay. Collectibility is not probable. The Ind AS 115 model fails. You cannot apply it until the collectibility issues are resolved. Okay. So for example, members of a group company entered into an intra-group sales transaction. So with a bid to boost turnover in order to meet the loan covenants. Okay. So I have H Limited. H Limited has taken loan from a bank, and as per the contract terms, you must have a turnover of at least 50 crores. of at least 50 crores. ये condition है. If you do not meet this condition, the bank will either revoke the loan or the bank will increase the rate of interest or do something detrimental to the entity. Now, end of the year aate aate H Limited realizes that it has not met the condition. H Limited has subsidiaries S1, S2 and S3. Holding subsidiary, I hope you are familiar. So what H Limited does is it sells the goods to S1, S2 and S3 repeatedly. Okay. It sold goods to them, increased or inflated its revenue and reported the numbers to the bank Now the question is, are you meeting the loan covenants? Yes. But is this amount from the subsidiary collectible? Answer is no. It's not the intention to collect only. It was just a way of round tripping the revenue numbers to the bank officials. There is no intention to collect, and therefore, as per Ind AS 115, the transaction between H Limited and its subsidiaries do not hold correct for the purposes of revenue recognition. Is it okay? Yes. Is it fine? So that takes care of collectibility, and then you are having non-refundable consideration. Non-refundable consideration. Sir, what do we mean by non-refundable consideration? Customer pays consideration which is not going to be refunded to him, which is not going to be refunded back to the customer. Okay. The question is, when should the revenue be recognized? When should the revenue be recognized? I'll give you an example. You explain to me, when will the revenue be recognized? Suppose you want to travel from Mumbai to Delhi. There is an Indigo sale which is going on. The cost of ticket under the sale is 1,999 rupees. The catch is, it is a non-refundable promo fare. It is a non-refundable promo fare. Okay, promotional fare. So 1,999 Mumbai to Delhi. Okay. Now the booking date of this flight is, you booked it on let us take today's date, 3rd October 2023. Travel date is, let us presume, 28th October 2023. So now my question is, when should the revenue be booked? You understood the facts of the case. You answer me, when should the revenue be booked? When should the revenue be booked? Okay. Should it be booked on 3rd October itself, that is today? Should it be booked on 28th October, that is the date of the journey? What do you think? Come on, I need answers. The non-refundable consideration was paid on 3rd October. Okay. All right. I need answers. Shankar gave an answer. Pooja gave the answer. Saravanan gave the answer. I need more answers. Come on. Tanisha, right? Ravish, Vanshika, Manisha, Ashu, Pooja, Manan, Sumit Jain. Mohammed, Sneha, Dheeraj, Rajiv, Yukta, Yedu. I need your answers, guys. I need your answers. Third October, right? It's not January. Okay. All right. Okay. 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 Yadu gave the answer. Ravish gave the answer. Saravanan gave the answer. Vanshika gave. Ashu gave. Manisha, Shruti. Okay. All right. Sumit, Sneha. Okay, fine. Now, all of you who said revenue should be booked on 3rd October, the basis for you to give that answer, I will tell you is, sir, fare to non-refundable hai. Fare is non-refundable, and because the fare is non-refundable, we should book the revenue immediately. We should book the revenue immediately. You will make very good businessmen. The people who said 3rd October should be the date of booking the revenue. You will be excellent businessmen. But what is the fact? Recollect the very first example that I gave today. Recollect the very first example that I gave today. The very first example that I gave today said that revenue should be booked as and when the performance obligations are fulfilled. You paid the amount to Indigo. You paid the amount to Indigo. Now, when you paid the amount to Indigo, sir, वो तो non-refundable है. Agreed, it is non-refundable. Agreed, it is non-refundable. Okay. But now, though it is non-refundable, is it mentioned anywhere in the standard that you saw? I gave you the 5-step model. I showed you also. What does it say? Recognize revenue as and when the performance obligation is fulfilled. As and when the performance obligation is fulfilled. All those who gave me 3rd October as the answer, look at the facts on the screen and tell me, when will Indigo fulfill its performance obligation? Is it fulfilling the performance obligation on 3rd October, or is it fulfilling the performance on 28th October when the flight departs from Mumbai and reaches Delhi? What do you think? When should it be? When it is fulfilling the performance obligation? Sir, it is fulfilling it on 28th October. People are starting to give me the answer. The performance obligation is getting fulfilled on 28th October. Once the flight departs from Mumbai, the system, the Indigo's computer systems, the moment the flight leaves the gates, the moment taxiing starts, that means the performance obligation is getting fulfilled. And the moment it is on the runway and takes off, it means the obligation has been fulfilled. The system should automatically transfer the entries from liability account debit, that is the advance from customers account debit, to advance from customers account debit to revenue recognized. Revenue recognized. Is it okay? Yes. Have you understood? But sir, this is non-refundable. No, ये तो भाई non-refundable है. इसमें what you can say, we don't have any risk or reason to give it. Agreed. You don't have any reason to give it. But merely because you have collected a non-refundable component of the consideration, do you think you can fulfill you can recognize the revenue prior to fulfilling a performance obligation? Answer is no. वो भले ही non-refundable हो, it will be parked under advances from customers. and it will shift to revenue only and only on the date when the performance obligation is fulfilled. Only on the date. There could be a possibility, see, understand, there could be a possibility that on 28th October, the engines of Indigo aircraft, the Pratt and Whitney engines, which you must be hearing so much, there is a possibility because of that failure, the performance obligation did not get fulfilled. And if the performance obligation did not get fulfilled, then you can be liable to refund the amount to the customers. There is a very, very remote chance, but yes, there is a scope that it can be refunded back to the customers. Why? Because the performance obligation itself is not fulfilled. Because the performance obligation itself is not fulfilled. Okay. The moot point of revenue recognition standard. Understand this. The main point of revenue is revenue should be booked correctly. Reversals of revenue should be avoided. Reversals of revenue should be avoided at any cost. Okay, because of an accounting mismatch, at least reversal of revenue should not happen. Okay, so that is a very crucial thing. That is a very crucial thing that you will have to keep in mind. If the passenger does not travel on 28th, if the passenger does not travel on 28th, then also the revenue will be recognized on the 28th. Yes, the passenger not traveling, you came to know on 28th only. But on 28th, the flight is already on its way to Delhi. Okay, so therefore, on 28th, the customer chooses not to fly. 28th is the date when you have fulfilled the performance obligation. Recognize the revenue on 28th only. On 28th only. Is it clear, everyone? Yes, is it clear? Anybody has any doubts, clarification? Yes. Yes. So non-refundable consideration received, you cannot book the revenue immediately. You cannot book the revenue immediately. Okay. A contract may not pass step 1, but entity may still transfer goods or services and receive non-refundable consideration. Receive non-refundable consideration in exchange for those goods or services. In that circumstance, entity cannot recognize revenue for the non-refundable consideration until either step 1 criteria are met or one of the events outlined below has occurred. So what is that? Entity has no remaining obligations to transfer the goods or services, or contract is terminated and the consideration received from the customer is non-refundable. Okay, so that is how you will deal with non-refundable consideration. You can go through this for your homework. Okay, all right. Next, so that takes care of a very preliminary discussion on identifying the contract. Okay. Yes. All right. Okay. Now, I want you to go through some of these questions by yourself. Illustration 1, 4. Okay, I will do 4 for you. It's very interesting. Okay, I will do question number 4 for you. An entity G Limited enters into a contract with a customer P Limited for the sale of a machinery for rupees 20 lakhs. Okay. P intends to use the said machinery to start a food processing unit. The food processing industry is highly competitive and P Limited has very little experience in the food industry. P pays a non-refundable deposit of rupees 1 lakh at the inception of the contract and enters into a long-term financing agreement with G Limited for the remaining 19% of the agreed consideration. So 20 may say he has paid 1 and remaining 19 is pending. So 5% and 19 point, sorry, 5%. This is 1%. Yeah, correct. 5% and 95%. Okay. Now enters into a long-term financing for the remaining 95% of the agreed consideration, which it intends to pay primarily from income derived from its food processing unit, as it lacks any other major source of income. Financing arrangement provided on a non-recourse basis, which means that if P Limited defaults, then G Limited can repossess the machinery but cannot seek further compensation from P Limited. even if the full value of amount owed is not recovered from the machinery. Cost of the machinery is 12 lakhs. P acquires control of the machinery at contract inception. When should G recognize revenue from sale of machinery to P Limited in accordance with Ind AS 115? Yes, go through this question again and tell me what should be the approach. Why is the slide not coming? अशोक जी, ये स्लाइड ठीक से दिख नहीं रहा है स्क्रीन पे. हेलो, ये YouTube पे स्लाइड कट रहा है. आवाज आ रही है? थोड़ा. अच्छा, अभी ठीक है. इट्स डन नाउ. मनन, आपको यू कैन सी द स्लाइड. So explain now. Read this question and tell me what are you going to do in this case. What are you going to do in this case? Okay. When should G recognize revenue from sale of machinery to P Limited in accordance with Ind AS 115? ठीक है, थैंक यू. ओके. मोहम्मद, श्रुति, यदु, मनन, तनिषा, पूजा, मनीषा, रवीश, धीरज, सुमित, श्रुति, आशु, आदित्य, और कौन है? कृष्णा, स्वाति, अश्विनी, अनिकेत जैन. I need your answers. When do we book the revenue. Okay. Read the question. Okay. Come on, guys. I need your inputs. It's not even so difficult. एक भी फिगर नहीं है जो कैलकुलेट करने लायक हो. Yes. Quick, quick. Okay. So Mohammed gave one answer. I'm waiting for the others. Read the question, understand the facts, and then give the answer. Okay. ठीक है. अच्छा. Let me put the facts in a written form. Okay. I have an entity G Limited enters into a contract with P Limited. P Limited is the seller. So Ind AS 115 applies to the seller. Okay. So ये तो हो गया पहली चीज. Now, sale of machinery for 20 lakhs. Okay. So machinery is what will be transferred for a consideration of 20 lakhs. Okay. P Limited pays a non-refundable deposit of 1 lakh at inception of the contract. Rupees 1 lakh non-refundable deposit transferred. So this is done. Next. Enters into a long-term financing for remaining 19 lakhs. Rupees 19 lakhs long-term financing. Okay. Which it intends to pay from the income derived from its food processing unit. The source of this 19 lakhs is what? Food processing unit. So G is going to set up a food processing unit. तो ये 19 लाख का पैसा कहां से आएगा? It will come from the food processing unit. The food processing unit is going to finance this 19 lakhs. Okay. Now, the food processing industry Wait, I'm sorry. I think I have done a mistake. Customer is P and this is G. Yeah, this is fine. Okay. P pays. Okay. Rest all is fine. So that is okay. Okay. Now look at some facts of P Limited. No experience in food industry. Okay. Second, highly competitive industry. Highly competitive industry. 19 lakhs to pay from food processing unit. Fourth, no other major source of income. No other major source of income. Now, the financing arrangement is on a non-recourse basis, which means if P defaults, G can repossess machinery. Without further compensation. Okay. Here are facts of the question. Now, what is the criteria that is required when you are assessing a contract? What is the criteria when you are assessing the contract? Is collectibility something that you will assess? Yes. It is probable that the entity will substantially collect all of the consideration. Look at the facts in the case and tell me, is it probable that the consideration will be collected? These are the facts of the case. P Limited is new in the food industry. Food industry is highly competitive. 19 lakhs it has said it will pay from the business and there is no other major source of income. If P Limited defaults in the payment, G can only repossess the machinery without any demand for what you can say, any damages, liquidation damages, etc. कुछ भी नहीं. He will just have to pay the what you can say, just have to pay the get the machinery, no compensation thereafter. You tell me now. Is collectibility in this particular case possible or difficult? Is collectibility possible or difficult? Is collectibility possible or difficult? Collectibility is not sure. Okay, Vanshika has answered. Anybody else with their comments, with their suggestions, with their okay. So Muhammad Shankar, okay. Yadu has given the answer. Saravanan has given the comment. Vanshika, Muhammad, yes. Tanisha, your answer please. Manisha, your answer please. Aditya, if you are there. Ashu, if you are there. Ravish, Dheeraj. Okay. collectibility appears to be difficult. Collectibility appears to be difficult. And because collectibility appears to be difficult, have you passed the first stage of the contract of the 5-step model? Answer is no. To pass the 5-step model, you should first be in a position to identify the contract. And when you should be in a position to identify the contract, when collectibility is going to be certain, when you are, it is probable that the amount will be collected in its entirety. So now, if collectibility is difficult, did you pass the contract? No, you haven't. And if you haven't passed the contract, how can I recognize the revenue? Even that 1 lakh what I received, I cannot show it as revenue. I will have to show it as a deposit. I will have to show it as a deposit, as an advance received from customers. The whole point is revenue should be recognized only when contract is approved by both the parties. Collectibility is going to be almost certain. Collectibility is going to be almost certain. And because of this, the contract is not an identifiable contract for Ind AS 115, and therefore we go and regard it as an advance that we have collected, as and when your circumstances change, your impact assessment also undergoes a change. Until then, it will be as an advance. The moot point of revenue recognition standard is, एक बार revenue recognize किया, the moment you recognize revenue, there should not be any ground to reverse the revenue. Okay, very rare circumstances you should be in a position to reverse the revenue. Otherwise, do not recognize the revenue in the first place. That is the whole logic, the whole reasoning behind revenue. Revenue is the most crucial figure in your P&L, the most. Okay, revenue is there. That means you are having the entire organization existing. So they do not want any kind of flip-flop between the revenues. They do not want any kind of hassle with the revenues. They want to keep it as pure a number as possible. Okay. In business combination, you will study goodwill also has a similar status. Revenue also in the P&L has a similar status. It is the basis for materiality for audit. It is the basis for disclosure in the financial statements based on the materiality related to revenue. All these things is what is done by the revenue number. And that is why the standard setters are very, very particular as far as revenue numbers are concerned. Okay. So that takes care of this illustration. Yes. So what am I going to do, sir? I am going to treat it as a what you can say, advance received, and revenue I will not be recognizing. You will recognize when the contract appears to become collectible. Okay, then the receivable appears to be collectible. Okay, so that takes care of this question. Next, there is this COVID-19 FAQ. I will explain in brief. 1st April 19, the customer was sound, able to pay. You entered into a contract. Thereafter, you had COVID, and therefore the customer went into poor financial condition, and thereafter there was uncertainty regarding the collectibility. And that is why how you will proceed is, on 1st April 19, jo bhi sale hua, book that sale, because on that day the pandemic did not exist. Okay. Later on, when you moved throughout 2019, when you came to 2020 also, it went through. Thereafter, on 1st April 2020, you had the full-fledged lockdowns and all which were going on. So therefore, on 1st April 2020 onwards, any sale that you were planning to make, you will not recognize the revenue therefrom. Why is that so? Because now there is uncertainty in the liquidity position. Because now there is an uncertainty in the liquidity position. And therefore, any sales that are effected with effect from 1st April 2020 will be, will be, what you can say, will not be recognized. 1st April 19 to 31st March 20, whatever was there, you have recognized. But what about those, what about uh, what about the sale which we had booked in respect of which consideration is not recognized, is not realized? Well, they are your debtors which are getting impaired. So you will have to do an impairment testing and record an expected credit loss in respect of those debtors. So that is how you are going to do. That is how you are going to do this particular question. Is it clear? Yes, FAQ 24, go through it for homework. Okay, you can take two dates, one for 2019, one for 2020 onwards. Okay, plot a timeline and try to do it. You should be in a position to get this. Okay, I want you to read this for homework. It's there in the study module. You don't have to worry. Okay, try to solve these questions for homework. Okay. No, don't solve this. Don't solve any of this. Okay. Try to read this particular identifying the contract, contract term and termination. You will have to go through this particular topic. It's just theoretical. Nothing major is there to be done as far as this is concerned. Okay. Tomorrow we will be starting with something important. Tomorrow means in the next session. Okay, we will be doing something more significant than what we did today. So just let me give you the page number for this. Contract term and termination. Okay, 5.12. Contract term termination. Okay, so this is page 5.11, 5.12. Okay, so go through this and then you will be able to understand better. Okay, 5.11 to 5.13. Okay, you can go through these pages and get an understanding of this. We will then continue with the illustrations in the okay, do this also after that. After you read this step 1, contract term and termination, I want you to do illustrations 2 and 3 also. Okay, I want you to do illustrations 2 and 3 also. Is it fine? Yes. Anybody has any doubts, difficulties? Don't want to do, want to do? Yes. Okay. Can you do this for me? Will you try? Okay. So please try that particular part and then that will conclude. Now I have to be starting something that is big in terms of content. It spans about roughly 1 to 1 hour 15 minutes. So I'll not be starting anything today. I'll have to do contract modifications. Once contract modifications is done, then your step number 1 is going to be completed. Okay, so we'll do the contract modifications in the next class. Okay. On this Saturday and Sunday, we are having 2 sessions. Those 2 sessions will be considerably longer. Okay, I will be taking long sessions then, because on weekdays I will be a little tied up for time. Okay, all right. Till now all is clear. It will be theory. Tomorrow also will be theory, but I promise you the next class on Thursday that we will be having, there will be lot more interesting examples to study. Okay. All right. Fine. So revise. Crucial thing is revise and come. What we have done, revise and come. You do not need the presentation to revise. I will tell you what all I have covered from the study material. I have the study mat in front of me. So you are requested to read this page, read the scope. Okay. Definitions you can go through. It's for your own clarity. You can see contract, customer, income. Income is same as per the conceptual framework. You can see performance obligation, revenue, standalone price, and transaction price. Don't look at these two right now. Contract asset, contract liability, don't refer. Go through the overview here. Then I have taken this, I have done this. Transition, don't go through right now. Step 1, identifying criteria for recognizing the contract. This one you can do. The parties have approved the contract and identify payment terms, commercial substance, probable, and then illustration 1. Okay. Then contracts that do not pass, reassessing. So this is what you will do. Then contract term, termination provisions, and these two illustrations. So till 13th page number, you are going to do this. You are going to do this for me. Okay. Revise and come. If you don't revise, Thursday's class, you will again be a little disoriented. Okay. So thanks everyone. See you guys on Thursday. Okay. Please share your feedback with the institute. We shall be very grateful if you want anything extra from our side. Yes, we'll be very grateful to you for your feedback. Okay. Thanks everyone, and see you on Thursday. Okay. Thank you. I'll try to avoid breaks a little bit so we can do more justice to the timing. Okay. All right. Fine. Sir, session end.